Hi everyone, my name is Brian Simelane. I'm a director at Learning Sims, a company that specializes in business simulations and game-based learning. I'm also very involved in teaching at business schools in the fields of finance, business simulation, and strategy. So today, my hope is really that we'll be able to have a discussion on, in truth, the subject that is not so difficult, but its application in business is rather difficult, which is financial management. What I hope we'll be able to cover over our time together is just what is financial management and how organizations operate from a finance perspective. The three principles that I want you to hold at the back of your mind. And even if you were to forget everything, if you hold these three principles financially at least, I think you'll still be making the correct decisions. I will also take you through the 5 key elements of financial management that you will always be managing within your business. And then we'll look finally at the strategy, how it links to your finance and also your personal goals, and just some questions that you need to keep at the back of your mind as you progress with your business. Now, if we think of financial management and what is financial management, what I've put here for you on the screen is breaking it down. It makes sense. You've got a financial component and you've got a management component. And on this financial component, we all understand and we all know that anything that is related to finances or anything financial is related to money. So it is the management of money. So money is at the center of this. But what is money? And this we'll speak about when we look at the key elements as well. Are you talking about cash when you're talking about money? Are you talking about profits when you're talking about money? Or are you talking about your worth? So how much assets you've got in relation to how much you owe other people. And it's very important to know that when we're speaking about financial management, it is not just one thing under this money umbrella, but quite a number of things. And on the management side, management as a science and as a discipline is involved with planning. All the time, we have to be able to plan. We have to be able to organize our resources, and we have to be able to control. Those of you who did business management and things like that would know of commanding and coordinating somewhere in between. But I think these 3 basic components of management are the most important ones when it comes to finance. So we are planning, we are organizing, and we are controlling all the resources related to our money. And how we define that money will change, and you will see that as we move through the rest of the activities. Now, there are 3 principles that are important, but before you look at the principles, you must understand how an organization operates from a finance perspective. I always say to people, it does not matter what business you are in. From a finance perspective, they are in essence the same. However, what differs, and if you're a creative entrepreneur, you will appreciate this even more, is how value is created and how value is communicated and how the customer actually receives and consumes that value. That's what is different in a business. But how it operates from a finance perspective is largely the same. So the first thing is the objective of any business is we want to maximize how much value we create for the shareholder. So shareholder value maximization is the objective. All businesses are the same from a finance perspective in that you need to get financing from somewhere. And we get financing from the shareholders in the form of equity, and we will get debt from other people, so in the form of equity and liabilities. If you want to start any business, you want to make sure that you've got money to do it. So whether you want to, create sculptures, and if those sculptures are made out of wood, you need the actual raw material, you need the machinery or whatever you will use. So you need to get money from somewhere. It will either be your money or it will be other people's money. And you put that together then, and you invest in your business. So the investing activities are then the next activities. And we invest only in one thing, which is then assets. These assets are then used on a day-to-day basis to deliver value in our businesses. And that is where our final activity in the business comes in, which is our operating activities. This is us delivering value, and we get income, and we'll deduct our expenses. And from that income or expenses, we will make a profit. Or if our expenses are greater than our income, we'll make a loss. That profit or loss belongs to the shareholders. So every business operates exactly like this. We're trying to make as much money as we possibly can for the shareholder. We'll get money from financing activities, either from the shareholder themselves and anyone who's willing to give us debt. We will invest in assets. These are things we will use to create value in the business. And on a day-to-day basis, on our operating activities, we will then deliver that value. That gives us income, and we incur expenses because we have to pay people, we have to buy stock, we have to do other things, and we'll have expenses. The difference between the income and the expenses is then your profit or your loss, and that belongs back to shareholders as well. So you understand how a business operates, but if you need to make financial decisions on a day-to-day basis, what are those key principles in finance that you need to know about? I'm using the word finance and financial management interchangeably, please. So if I say finance, I mean financial management, and if I say financial management, I mean finance. They're the same thing. The first key principle of financial management or finance is what we call cost versus benefit. The cost versus benefit principle says every financial decision that you make, you must make sure that the financial benefits of that decision are always greater than the cost of that decision, or the related cost. So if I am going to buy a vehicle for my business, there is a cost related to that vehicle, and I must consider what are the benefits of having this vehicle in my business. If I'm a courier company and I buy a van, I'll pay 300,000-400,000 rand for the van, but I will generate more than 300,000-400,000 rand in income by delivering to customers. But if I am buying the vehicle for a director in the company and we buy, 600,000 to R1 million type of a vehicle, what are the benefits of that vehicle? We are not delivering stuff, so we must now be looking at the benefits related maybe to the perception around the brand. So if it's a R1 million car, we think that if you will attract customers that will make more than R1 million in terms of income to you. So that's the first principle. It's the cost versus benefit principle. The second principle is the principle of risk and return. Every business decision carries risk, and risk just means that we are not sure what the result is going to be. So from what we are making and the result in between is the risk. From the decision we're making to the result is the risk. So the risk versus return principle says the higher the risk, the higher the expected return. So if you're entering into a risky business deal, you must expect that that risky business deal is going to yield more financial return for you than one that is less risky. Hence, if we go to a bank as small business owners, if the bank does indeed give you money, you will see that the interest rate is also higher because they're saying the risk that you will default on this loan is high, and therefore the return that we want for it is also pretty high. The final principle is the principle of time value of money. And this is saying that how much something is worth today, you must always consider with how much it will be worth in future. So for example, if you invest the 500,000 in your business today, so it's in today's term, and you tell an investor that they will get that 500,000 in 2 years' time. Obviously, in 2 years' time, inflation has kicked in, and that 500,000 cannot actually buy what it could buy today. So you possibly should not be giving them 500,000 in 2 years' time, but rather 700,000 or whatever the return you are giving them. So we make decisions today, and money and cash might flow today, but we must also consider what is the future impact on that particular money as well. Now, these are very easy, and I say you must keep them at the back of your mind, especially as you go through the different elements of financial management that you will be managing. There are 5 key elements that you will always be dealing with, and I want you to really focus in terms of don't make a decision related to only one element. The first element you will always be managing in your business is the element of profitability. And profitability merely means that you are always making sure in your business that your income is always greater than your expenses. So it therefore follows logic that you know how much your expenses are and you know how much your income will be. The second key element that you need to manage in your business is liquidity. And liquidity speaks to cash. It is possible in a business that you could make a profit but have no cash in the business. And easily how it happens is you sell to someone on credit. On the day you sell, that income is recognized in your business, but there's no cash. So the cash might come months later. And that's how most businesses die. They run out of liquidity, even though they may appear to be profitable on the books, because the cash comes in later than what the expenses need to be paid. So liquidity is the second key element that you must manage in your business. The third one is managing activity. How fast are things happening in your business? And this normally relates to how fast are you selling when it comes to stock? How fast are you being paid by your customers? And how long does it take you to pay others? So, because these are the things that influence your liquidity as well. So you need to make sure, as much as possible, you are selling all the time. You're selling all the time. There's activity when it comes to selling. There's activity when your customers come to paying you. And ideally, you want to take long to pay your suppliers, but we are also managing relationships with them. So we don't want to take too long. So that is the other element that you need to manage in the business. The fourth element is related to solvency. And solvency merely means the use of debt in the business. If you owe a lot of people, it puts pressure on you because it increases even the interest that comes from that from that loan as well. So over a long term, we do encourage you to use debt because you can use debt to actually generate more profits. But you need to make sure that you're balancing that debt with your ability to pay that debt. And then the final thing is the market. And the market is always looking outside. So you don't want to always just have an internal view of your business. You want to always consider what is happening out there. Even from a pricing perspective, what are other people charging? Not for you to target that price, but to consider whether you want to actually go into that price war. You want to price higher than the customer as well, the competitor as well. So the market and what is happening out there is always important. As an example, the governor of the Reserve Bank comes on the TV and changes the repo rate of the country. Now, what is the impact of that on you as a business? You must also be thinking it might change your cost of borrowing from the banks as well. So as we manage our business, we want to make sure, are we profitable? Do we have cash? Are we making things happen pretty quickly when it comes to activity? Are we able to pay our debt? And are we well positioned in the context of the external environment as well? So as you're busy with these things, there's always a consideration. And here it's just for you to think about this, is you will have your own internal finance that you're managing and your own strategy. And these two things must always link together. And your strategy speaks to how are you going to win out there. But I've also put this last one because sometimes when we are analyzing the performance of small businesses, we measure them against whatever targets we want to create. So if a shareholder wants to measure you, they will say, can you scale or whatever, because they're looking at what they can get from that business if they invested in it. But you have to also consider, what are your own personal goals? Because those personal goals might affect what results you want ultimately out of the business and the strategy that you will follow in the market. As an example, let's say someone wants to just is working somewhere and they earn 20,000 Rand as an employee, and they want to replace that and stop working and become self-employed. Now you realize that if that business is able to generate 20,000 Rand a month or more for that particular person, they may consider it to be a success if that is a personal goal. And that will then flow that the profits in this business must be at least 20,000 Rand, or if the salary is part of the expenses, they might say we just want to break even, and ensuring that that 20,000 Rand is covered. Now, if you are fighting in the market with someone who just needs to make 20,000 Rand, it's a different fight when it comes to strategy to someone who maybe might be trying to make 1 million Rand a month. So these three things always linked together, and you must always remember, what are your personal goals and how do they affect how much money must be made in the business, and ultimately how are you going to fight in the market. Now lastly, I just want you to consider some questions that are important as you make all these financial decisions. And I think you must write these questions down somewhere, and you must always consider them. And even if you're not so strong with numbers and things like that, if you know the answers to these questions, when it comes to financial management, also knowing those three key principles, I think you should be okay and you should be able to perform well financially. The first one is whether you understand how your customer measures the value that you give. This is very important because this will affect you when it comes to simple things like how are you going to price that particular thing. If you are selling something to me that I believe as a customer is very rare and it's very valuable, then you can charge me anything. But if you are selling something to me that you believe has a lot of value, you've put in a lot of customization, and yet I just see it as a generic product, it will be problematic for you as a business owner then to be able to price that at the correct level because I don't value it at the same way. The second question that you need to consider as a business owner is, do I know the real costs for me to deliver this value? My argument is always that small businesses are not failing at pricing, but they're failing at costing. If I need to deliver value, have I considered every single activity that comes into the delivering of that value and how much that activity actually costs? Take, for example, if you as an owner need to do something in the business, there is a cost because your time is there. How much is your time worth? Well, it depends what you do. So if you say you want to earn 60,000 Rand a month, you will divide that 60,000 Rand by how many hours you believe you're going to be working. And that's how much you should be charging for every single hour in every single project. So do you know how much it costs you to deliver that value? Because if you know how much the cost is, the difference between the cost and what the price is going to be the profit, and it's not going to surprise you in future. The third question relates to your personal goals. Like, how long are you going to do this? It's an important question in a sense that it sometimes defines what numbers you're trying to get out. So for example, if you are building a business to sell within 3 years and you want to be selling for a couple of millions, it's a completely different business to a business that you want to leave to the next generation, because there you've got time, and even how you finance that business is very different to a business that's going to be sold right now. So consider for yourself, how long are you going to be in this particular business? The next one is, what is happening out there? And it might link to the previous question. So what trends are there technologically, socially, environmentally? What is happening out there in the industry that you are in? Because these are very important so that you don't remain stagnant, trying to do something over and over, and then the finances just don't come in because you have not responded to what is happening outside. And then my last question is, what can I commit to doing in this business? What are the things that you think you really can and you're going to commit to those ones? And it's very important, your level of commitment in the business is not just related to how much time are you going to spend in that business. It might mean that you must commit time elsewhere to gain certain skills that you never had before and that you can then apply in the business. Or you're not going to do that. You're going to get money from somewhere and you're going to acquire those skills from somewhere. What are you willing to commit into this business? And you knowing the answer to these questions will really frame your mindset in terms of what do you expect to happen in this particular business. So that was our financial management session. It's normally a very stressful topic to talk about, but I want you to actually look at it quite positively in a way that you know that it is simple and you know that you can make the decisions. Just follow the principles that I've given you. Manage the five key elements that are in the business. Think about how your strategy links to your personal goals and what numbers you expect. And know the answers to those questions. If you have any questions, please don't hesitate to drop me a line as well. And I wish you all the best in your business.